Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Finally, some relief is upon us. The Fed pulled the trigger on a 50 basis points rate decrease, and the world has breathed a collective sigh of relief. For the very large majority of businesses and consumers out there, a dip in rates is a good thing. There are exceptions, of course, which I'll touch on later. But first, let's discuss why a drop in rates is something that gets celebrated by investors. I can think of at least 3 good reasons why lower rates will be great for most equities. And of course, during the pandemic, we were given the ultimate real-world example of the impact of interest rates. It just happened far more quickly than usual. It was so much more aggressive than usual, with sharp cuts and then severe hikes as inflation started to run away. Be thankful for that lesson, because I believe that it allowed an entire generation of investors to learn so much about interest rates. Let's begin with the most basic reason why the market loves a drop in rates. Debt is getting cheaper. If a company generates R1 million in EBIT, or earnings before interest and taxes, then the return to shareholders will very much depend on not just what the tax man takes, but also what the banks take. Just look at Met Air as a locally listed example. The underlying businesses are not great at EBIT level, but they are at least making money. But once you factor in the lenders and take interest off those earnings, the group is in a really bad state at the moment and needs to reduce its debt. Now, any relief in interest rates reduces the cost of debt, and it means that more of that EBIT is going to go to shareholders, not the bankers. It's why banks generally do well in an increase in rate cycle and can underperform in a decrease in rate cycle, although I will touch on that point again later. The profits are like a cake, and the way it gets sliced and shared will depend very much on prevailing interest rates. If the interest rates are lower, there's more cake for shareholders. And when there is more cake for shareholders, there is naturally a higher value placed on those shares. After all, who doesn't love cake? And this is the first reason why stocks rally when interest rates decrease. Now, on to the second reason, which is also an easy one to understand. In a country with highly indebted consumers and businesses for that matter, a drop in interest rates means that there will be more discretionary income running around to be spent on goods and services. This is particularly great news for consumer-facing businesses, especially those selling durable goods that tend to be financed. Think about car dealerships, for example, although go back and listen to Supernatural Stocks published on 7th September, where I talk about the disruption from Chinese car manufacturers and how I'm worried about some of the local players in the car dealership sector. Companies with a B2B strategy also tend to benefit here, although the effect is not immediate like it is for durable consumer goods. A drop in rates tends to unleash a wave of consumer spending, which is exactly why central banks are so careful not to cut too early and allow inflation to run away. Conversely, although businesses will love the fact that rates are a bit lower and they can start to invest and spend more, they tend to be a little bit more cautious. And just touching on the banks again, this is the counter-argument to the first point I made. If consumer demand for credit and the quality of the credit book improves dramatically as rates have come down, then this can outweigh the negative impact of cheaper debt, which means cheaper pricing of effectively the bank's product. The banks can still be net winners if there's enough demand to outweigh that, but generally speaking, I think the banks do struggle when rates are dropping. I discussed how banking earnings work in Supernatural Stocks back on the 1st of July, so go and check that show out. It's as relevant today as it was back then. To bring this second reason to a close, the point here is that if there is more money floating around for goods and services, the providers of those goods and services, i.e. all those listed companies, will benefit. Hence, their shares rally, especially the likes of retailers. Just have a look at how the clothing retailers have behaved with the news of a decrease in rates. Reason number 3 is the most technical one, but it is really, really important. The value of a company today is the present value of its future cash flows. To express those future flows as a present value, i.e. in today's money, we use what is called a discount rate. Now, I think it's quite a misleading term because we're not working out some value and then putting a discount on it. No, we are simply using a rate of return to bring the cash flows back to today's money, to discount them back to today's money. Think about inflation. and how it means that 100 Rand today is equivalent to, say, 105 Rand in a year's time. It's the same principle, we're just working backwards. Now, the lower the rate at which we discount those cash flows, the higher the present value. When interest rates come down, the value today of those future cash flows, all else being equal, just went up. But now if you add in the benefits of increased consumer spending and a generally better environment, you get this flywheel effect where not only are the flows worth more in today's money even if they were the same, but those flows themselves are actually expected to be higher than before. So you have more money in future, which is worth even more today. If you would like to do some more research into that topic, check out the concept of a discounted cash flow valuation. It explains much of what we saw in the market when interest rates were at all-time lows during the pandemic, with nonsensical growth stocks trading at crazy multiples because people were forecasting very high future cash flows and then discounting them at a low rate. That ended badly, not just because of a total lack of realism, but also because interest rates were subsequently increased significantly, and thus the present value of those flows decreased rapidly. I mentioned earlier that not everyone is a winner from lower rates. I already gave the example of banks as a tricky one to predict. It could kind of go either way. I think they will be more on the losing end than the winning end, to be honest. Another one is insurance groups who have very large balance sheets that get invested in the market, and particularly in fixed income instruments, as they need to try and manage the risks that are inherent in the insurance book while maximizing returns. Although a portion of their investment inevitably sits in equity and they will get that uplift, I've noted that many of the insurance groups have highlighted strong interest rates as a very helpful source of recent returns. Keep an eye on that one. And of course, we cannot forget pensioners. Their retirement savings are sitting in fixed income instruments, and although there will be fixed deposits and other structures in place to give them some protection, an ongoing drop in rates does make things harder for them. Generally though, the lower rates are accompanied by lower inflation. I mean, that's what caused the rates to come down in the first place. So those pensioners tend to come out okay until inflation starts running hot again and interest rate hikes lag inflation. Market cycles are ridiculously powerful things. I do hope that this has helped you understand why the markets turn bright green when rates finally start dropping. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.